wherever you are and whatever time you're listening to this. Good morning, good afternoon, and good evening. This is the Market Color Podcast, where we keep you posted on the latest developments in the financial markets with a view to helping you better understand how the markets operate so that you can make informed investment decisions. And we do that by first giving you a broad overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 179. And in this episode, we're reviewing the performance of the financial markets during the 39th week of 2025. And that is from Monday the 22nd to Friday the 26th of September. And without further ado, this is your host, Jamuhuri. And together, let's dive right in. We kick it off in the United States, where, according to a report released by the Commerce Department on Thursday, the U.S. economy recorded its highest growth rate in nearly 2 years during the second quarter of this year. The stronger-than-expected growth was driven by strong consumer spending and business investment, though momentum appears to be slowing down as the effects of tariffs and policy uncertainty begin to filter through the economy. Not surprisingly, the economy recorded a sharp contraction in the trade deficit as the inflow of imports begins to slow down due to higher tariffs. The economy's resilience was underscored by other data showing strong demand by business for equipment, driven by a spending boom on artificial intelligence and a drop in first-time applications for state unemployment benefits, indicating that companies were holding on to their workers. These latest data suggest that the Federal Reserve may reconsider further easing of monetary policy going forward, as the U.S. economy appears to be in pretty good shape for the time being. Staying in the United States, data released by the Commerce Department on Friday showed that core inflation was little changed in the month of August, signaling that the Federal Reserve will most likely continue to ease monetary policy going forward. The Fed's preferred measure of inflation, that is the Personal Consumption Expenditures Price Index, showed that the annual headline rate of inflation in August came out at 2.7%, which was a slight increase from the 2.6% in July. Meanwhile, the core rate of inflation, which excludes volatile food and energy prices, this came out at 2.9% in August, which was the same rate as the previous month. During its policy meeting last week, the Federal Reserve projected 2 more rate cuts of 25 basis points each before the end of the year in order to bring inflation down to its target rate of 2%. For your information, the Federal Reserve considers the Personal Consumption Expenditures Price Index as a better measure of longer-term inflation trends, as it provides a wider view than other reports and takes into account changes in consumer spending habits. On Wall Street this past week, Stocks climbed on Friday but still finished the week lower than they had opened following the release of the latest inflation data. The markets continue to price in at least 2 rate cuts of 25 basis points each before the end of the year, in line with projections from the Federal Reserve. The inflation data swayed the market, with stock futures ticking higher on the prospect of lower interest rates, but a strong upward revision in economic growth for the second quarter slightly dampened the bullish sentiment, as a stronger economy will give the Federal Reserve less impetus to continue cutting interest rates. Friday's rally snapped a 3-day losing streak for all the 3 major indices, but they still ended the week on a lower note. The Dow Jones Industrial Average advanced by about 300 points on Friday, but was still down by 0.2% for the week as it came to a close at 46,247. Meanwhile, the broad market index, that is the S&P 500, shed 0.3% to close the week at 6,643, whilst the tech-heavy Nasdaq Composite slid by 0.7% over the past 5 days to finally settle at 22,484. In the government bond market, U.S. Treasury yields were little changed on Friday as investors analyzed the latest inflation data to determine what it could mean for the future direction of monetary policy and the U.S. economy. The data showed that inflation remains well above the Fed's 2% target rate, with strong economic growth in the second quarter and a resilient labor market, which could make the Federal Reserve less inclined to continue cutting interest rates. This comes barely 1 week after the Fed implemented its first rate cut this year and signaled it was looking to deliver another 2 rate cuts of 25 basis points each before the end of the year. In response, the yield on the benchmark 10-year Treasury bond ticked up by less than 1 basis point to close at 4.18%, whilst the yield on the policy-sensitive 2-year Treasury note ticked down nearly 2 basis points to end the week at 3.64%. For your information, 1 basis point is equal to 0.01%, and bond yields and prices move in opposite directions, which means that as interest rates rise, bond prices fall, and vice versa. In the foreign exchange market, the dollar edged lower on Friday, but was still on track for its second consecutive week of gains against other major currencies after data showed that the U.S. economy remained resilient, which could complicate the Federal Reserve's outlook that is geared towards cutting interest rates. The dollar was on track for its 5th consecutive week of gains against the Japanese yen and was last recorded trading at 149.65 yen to the dollar. And against the euro, the dollar snapped a 3-week winning streak and was on course to finish the week a tad bit lower at $1.1684 to the euro. In a nutshell, the dollar index, which measures the greenback against a basket of 6 other major currencies, this was on track for its second consecutive week of gains with a reading of 98.33. In the commodity markets, the price of crude oil rose on Friday as Ukraine launched a series of drone attacks on Russia's energy infrastructure that seriously impacted the country's fuel exports. Following the attacks, Russia announced that it would introduce a partial ban on diesel exports until the end of the year and extended an existing ban on gasoline exports. The ongoing war has raised tensions in the wider region, with NATO issuing a warning to Russia that any further violation of member nations' airspace could result in additional sanctions on Russia's oil industry. In response, the price of the global benchmark Brent crude rose by 1.02% to close at $70.13 a barrel, whilst the US benchmark, that is West Texas Intermediate crude, increased by 1.14% to settle at $65.72 per barrel. In the precious metals market, the price of gold rose on Friday after U.S. inflation data came out in line with market expectations, reinforcing bets that the Federal Reserve will implement 2 additional rate cuts before the end of this year. According to the CME's Fed Watch tool, futures traders are now pricing in about an 88% probability for a rate cut in October and a 65% chance for another rate cut in December. Gold is considered as the ultimate safe haven asset and is traditionally viewed as a hedge against inflation and economic uncertainty, and tends to perform better in a low interest rate environment since it doesn't pay out a regular coupon like a bond. After hitting a record high of $3,790 earlier in the week, the price of spot gold rose by 2.5% this past week before eventually coming to a close at $3,777 per ounce. We now change scene to the Kenyan financial markets. And we start by looking at the domestic foreign exchange market, where after 7 weeks at the exact same spot rate, the Kenya shilling ticked up by 2 cents versus the US dollar. And according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.26. Meanwhile, the sterling pound was priced at 173.64 and the euro was valued at 151.71. And on the regional front, 1 Kenya shilling was changing hands for 27.04 Ugandan shillings and 19.07 Tanzanian shillings, and to the Rwandese franc, it was posted at 11.22. Despite the central bank operating a floating exchange rate policy, the dollar-shilling exchange rate has been staggered between 129 to 130 shillings over the past 2 years and now appears to be operating like a fixed exchange rate. Given this previous price action and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the shilling still remains negative, and this is evidenced by the country's excessive national debt, which now stands at about 70% of the country's gross domestic product and consumes about 60% of total revenue collections. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves declined for the second week in a row, and this time was down by $126 million for a grand total of $10.73 billion, which is equivalent to 4.7 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this fact, Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. In the money markets, during the past week, the interbank market was sufficiently liquid and remained well-funded with the support of the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and interest rates in the interbank market. The overnight interbank rate, which is now referred to as the Kenya shilling overnight interbank average, this is the rate that banks used to lend to each other and is now the new reference rate for all lending transactions by commercial banks. The overnight interbank rate was stable at 9.48% and was pretty much in line with the central bank rate, which still stands at 9.50%. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio of 3.25%, this stood at 2.4 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 25th of September, and the central bank received bids totaling to 15 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 63%. The central bank ended up accepting 14.9 billion shillings, and the results of the auction were as follows. The 91-day rate dipped by 3 basis points to settle at 7.91%, whilst the 182-day rate declined by 2 basis points to break below 8% and close at 7.98%, and the 364-day rate held steady to average out at 9.53%. In the primary bond market, the Central Bank of Kenya has published its prospectus for its October bond issuance, in which it is looking to raise a total of 50 billion shillings through the sale of 2 reopened fixed coupon treasury bonds whose terms and conditions are as follows. The first bond is a 15-year bond initially issued in 2018 and now has 7.7 years left to maturity. This bond matures in May 2033 and has a coupon rate at 12.65%. The second bond is a 20-year bond initially issued in 2021 and now has 15.9 years left to maturity. This bond matures in July 2041 and has a coupon rate at 13.44%. Both bonds are now open for sale until Wednesday, the 15th of October, when the auction will be held. At the Nairobi Securities Exchange, during the week, the equities market was on an upward trajectory, with the NSE 10 gaining the most by 3.7%, whilst the NSE 25, the NSE 20, and the NASI gained by 3%, 2.6%, and 2.5% respectively. This takes the year-to-date performance to gains of 44.7% for the NSE 20, 41.9% for the NASI, 34.7% for the NSE 10, and 34% for the NSE 25. The market's performance was driven by gains recorded by large-cap stocks such as Cooperative Bank, which increased by 10.4%, Equity Bank was up by 7.4%, and Kenya Commercial Bank rose by 6% flat. Up next is our topical issue, and this week we're looking at the proposal to classify pending bills as public debt. The Controller of Budget, Dr. Margaret Nyakango, is pushing for pending bills and county governments to be recognized as public debt in order to curtail their continued growth and to speed up their repayment. She said that leaving pending bills outside the legally recognized public debt has allowed counties to continue accumulating unpaid debts and is threatening the prudent financial management of devolved units. In addition to loans and securities, the Controller of Budget is now calling for a legal review so as to include pending bills in the definition of public debt for county governments. According to her report on budget implementation for the year ending June 2025, Section 2 of the Public Finance Management Act 2012 defines county public debt as all financial obligations associated with loans raised and securities issued by the county government. However, when this section is examined alongside sections 140 to 144 of the Public Finance Management Act, it becomes clear that pending bills are excluded from this definition of public debt. The Controller of Budget argues that the failure to include pending bills as public debt has caused many counties to neglect debt management strategies on the misguided basis that they have little or no pending debts, whilst the reality is that they continue to accumulate pending bills which now run into the billions of shillings. The Controller of Budget is recommending that the Public Finance Management Act 2012 be amended to broaden the definition of county public debt to include pending bills that remain unpaid beyond one financial year. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if that is the case, please share it with your family and friends and help to keep them informed of the latest developments in the financial markets. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. For more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major hosting directories, that is Apple Podcast, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address, that is jamhuri@gmail.com. Jamhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, do the best you can until you know better. Then when you know better, do better. A quote by Maya Angelou. Think about it. Thank you, and God bless.